Hey everyone, welcome back to our channel. This is Vaibhav Bansal. Today we are going to start with our new chapter under the TT exemption series, that is profits and gains from business or profession, PGBP. So starting with the charging section, section number 28. It prescribes the certain conditions from where the income is earned from these sources will be specifically charging to the PGBP chapter only. The following items inter alia shall be chargeable to tax under this head. This head is PGBP. What it says, the profits or gains of from business or profession which is carried on at any time during the previous year. If you are carrying any business or profession at any time, not it is important that you are just carrying on your business at the end of your previous year. It is not at all important. At any point of time during your previous year, if you have conducted any PGVP, any business or profession, and you have earned any business profits and gains, then it will be taxable under section under the chapter PGVP. Next, any interest, salary, bonus, commission, or remuneration of a partner from his firm. You know, when a partner receives any interest, salary, bonus, commission, that then the partner is exempt, but the firm have to give the tax. So only up to the extent whichever is taxable to the firm's hand is exempt. Otherwise, over and above what is not taxable in the hands of the firm will be taxable in the hands of a partner. It is said, but only up to the extent which is allowed to the firm considering the provisions of 40B. Whatever the firm is exempt, now it will be chargeable to tax for the employees, for the partners. Now, export incentive, profits on sale of import license, cash assistance, and duty drawbacks, all these things will be taxable in PJP head only. Value of any benefits or perquisites arising from any business or profession. If you are carrying any business or profession, and in relation to that, if you are having any, if you are earning some benefits or perquisites in whether in money or in kind, whether it is convertible into money, whatever it is wholly in cash, wholly in kind, or partly in cash or partly in kind, whatever the combination is, whatever the permutation and combination is, if there is any benefits or perquisites arising from business or profession, then it will be taxable under the head PGBP. I hope it is also very much clear to you all. Now, any sum received or receivable in cash or in kind under an agreement. If you have entered into an agreement and receiving some cash or receiving some in something in kind in relation to your business, the agreement, what kind of agreement can be? It can be a non-compete agreement, like you will not compete in this arena. I am saying to someone that I am in this zone, I am in this field, I am in this geographical area. So another business which is identical to my business, I am saying to those, please do not operate in this area. I just want to be separate in this area so that I can apply my monopoly. So I am paying some compensation fees to that another shopkeeper or maybe the business owner, that you may please shift your business from this zone to another zone. So for that, if for non-competing, if I am paying any sum of amount for non-competing with me, then it will be chargeable under the head PGP. But I am saying what, it is a non-sharing fees. Like I have developed an patent with some person. Now what I am saying, please do not claim your rights on this patent. I am giving you a lump sum amount of money and just forego your rights on this patent. If I have said that for the non-sharing of fees, I do not want to share anything on this license, on this copyright. If I do not want to share anything on this copyright or patent, then it will also be a non-sharing fees, and it will also be a taxable under the head PGBP. I hope this point is also very much clear. Now, any compensation or the other payment received or receivable, whether revenue or capital, in connection with the termination or modification of the terms and contracts of any contract relating to his business, not profession. Whatever I am going to tell in the point number 6, it is only relevant for the businesses and not relevant for the profession. What it says, if you have paid any compensation, or if you have to if you have to receive or receivable any compensation in relation to what, termination or modification of any contract. If you have entered into a contract and the terms and conditions are now being modified, or the terms and or the contract may be terminated, if any sum received or maybe receivable under under that circumstances, then what will be done, then it will, the amount that you will receive or may be received in future will be taxable under the head PGP. The receivables are also taxable. You should not only receive, but if you have any receivables, then also it will be taxable under the head PGP. Now, any sum received under the Keyman life insurance policy, including the bonus of such policy, if the Keyman insurance policy, any sum received under the Keyman insurance policy will also be taxable under the head PGP. Okay. Now, income derived by trade, profession, or similar associations from specific services provided performed to its member. If any organization, any like a cooperative society or maybe a trade organization, maybe a professional organization. Okay, what they have done, they are providing specific services, maybe a loan services they are providing to their members. So the loan income that they are earning will also be taxable. The interest income that they are earning will also be taxable under the head PGBP. I hope all the charging sections, section number 28, I hope it is very much clear to you all. Now, moving forward, section number 30. What section number 30 says? It says about rent, rate, taxes, repairs, and insurance for building. It says rent, rate, taxes, repairs, and insurance for building. Any rent paid shall be allowed a deduction to the tenant of the property. If the tenant is paying any amount of rent to the landowner, the rent paid will be allowed as deduction to the tenant. Okay, any amount spent on revenue repairs of the property, municipal taxes, and or any other local taxes paid, insurance premium paid is also allowed to the tenant. What it says, if the tenant has done any revenue repairs, not the capital expenditure, any revenue repairs, like there is a just minor water leakages are there. So if the tenant has done that has done that water leakage repair, then it will be considered as a revenue leakage, revenue repairs. It is not a capital repairs. Okay, so all the revenue expenditures or the municipal taxes, local taxes, insurance premium, whatever they have paid is allowed to the tenant. But any amount on account of a capital repairs, if the tenant has paid anything in the capital repairs as a capital repairs, then it is not allowed as deduction. But listen to it very carefully. But the capital repairs will be granted to you as a depreciation. You can add it to the value of the building, and as per the building rates, as per the block of the building, whatever the rate of depreciation is, you can charge that rate of depreciation. You can charge that depreciation. Explanation 30, explanation 1 to section number 32. Okay, then the however tenant can be treated as deemed building as per explanation to section 32, and hence depreciation can be claimed. And the property owner who have done what, capital repairs, if I am the owner, I can capitalize it to the cost of the building, and after capitalizing it, I will get the deductions of it. Okay, it says the same thing. And for the property owner, it can be capitalized with the cost of building, and the depreciation can be claimed. Now coming on to the section number 31, what it says, now it is talking about plant and machinery and furniture. Plant, machinery, and furniture. Okay, but only two things, repairs and insurance. Above what we said, rent, rate, taxes, they are not talking about these three things. They are talking about only repairs and insurance. They are only talking about what, repairs and insurance. So now under section 31, everything remains same. Everything remains same. The repairs must not be in the capital nature, hence only the repair and the insurance deduction is given for rent paid. No deduction under section 31. Rent paid, if there is a rent paid for the plant, machinery, and furniture, will there be any deduction? No deduction, because section number 31 tells about what, repairs and insurance. But if it is paid for your business, if the rent paid is for your business, then you can claim deduction under the general deduction section, that is section number 37, which talks about the general deductions. If any expenditure is done for your business and it is not for a personal purposes, then you can claim deduction, and it must be should be the it must be the revenue expenditure, not the capital expenditure. If you are recalling, then the section number 37(1) can be applied, and the deduction of rent paid is also be granted. But under the section number 31, that will not be granted to you. Now coming on to the section number 32, the most important section of your chapter, the depreciation. In every question of your PGBP, the depreciation question is to be taken care of. Depreciation calculation is to be taken care of. So this is the most important part of your examination purposes. So so remember it very carefully. Depreciation is allowed on the building, machinery, plant, and furniture being tangible assets. See, simple. Depreciation is allowed on the tangible and intangible both kind of businesses. First is tangible, second know-how, patent, copyright, trademark, license, franchisee, or any other business or commercial right of a similar nature being intangible assets, not being goodwill of the business or profession. But remember one thing, business or profession. If there is any goodwill related to the business or profession, for that there will be no allowance of a depreciation. Depreciation will not be available on the goodwill. Otherwise, every tangible and the intangible things you will get the depreciation. I hope it is very much clear to you all. Now, what it says, such assets should be owned and used for the purpose of business or profession by the assessee. If you want to take depreciation, then it should be used for your business, not for your personal purposes. Okay, then the depreciation shall be allowed on a WDB basis on the block of asset at a prescribed percentage. Now we have to understand what the prescribed percentage is, what the block of asset is, what the meaning of WDB is. If we understand these all things, that it is very much clear. So the depreciation will be allowed on the WDB of the block of assets at a prescribed percentage. But before that, we have to take care of one thing, that the plant which we have talked about here, everything. The plant should not include the tea bushes and the livestock or building or furniture or fittings. Building furniture fittings are different. You know, everything is building furniture fittings is every different, that you all know. But the important thing that you need to remember is tea bushes or livestock are also not part of a plan. Now, relevant notes to take care of. What are the notes? In case of a lease, irrespective of the type of lease, what are the types of lease? Finance lease or the operating lease? Irrespective of that, lesser, who is leasing, who actually owns the asset. If they are leasing, will be entitled for depreciation. The lesser will be entitled for depreciation if he is engaged in the leasing business, not the lessee. Not the lessee, it is a lessor. O R lessor. Okay. Now, in case of hire purchase agreement, if there is a hire purchase system, then the hire purchasee can also, the depreciation shall be allowed to the hire purchaser in view of the CBDT. The hire purchaser, here also the hire purchasee is not available. The depreciation is available to the hire purchaser. I hope it is very clear on the cash price. Okay, these all points are also confirmed by the case laws. Now, beneficial owner, we have to see the beneficial owner. We do not need to see in whose name the building, the plant and machinery and everything is owned by. Who is owning that particular asset? It is not at all relevant to you. What relevant is, who is beneficial owner, who is actually taking the benefits from that asset. If I am taking the benefit from that asset and the asset is owned by you, it is not very much important that the asset is owned by you. If that asset is owned, if it is used by me, then I am the beneficial owner and all the provisions will be applicable to me. The beneficial provision has to be seen. Registration of the name of the registration right is not determinative of the ownership. It is not determinative. Maybe I have transferred the land to you, but the registry is done after a month, after a 2 month. There may be some possibilities. So for that 1 or 2 months period, if I am using that property, then I will be known as a beneficial owner. Okay. After taking the possession of a building in pursuance of an agreement to sell, he shall be considered to be the deemed owner, and the depreciation will be shall be allowed even if building is not registered in his name. The depreciation will be allowed even the building is not registered in his name. Now, what is the general rule? Assets which are ready for use but not actually put to use during the relevant previous year are not entitled for depreciation. What it says? It says there is a general rule. What is the general rule? If the asset is ready for use but not put to use, if it is ready to use but not put to use, then no deduction, no depreciation will be allowed. This is the general rule. But there are some exceptions. Like if the asset is of such nature which requires special use, which special use, like a fire extinguisher. Fire extinguisher will be only used when there is a fire in your business, fire in your building. Then it will be used. So the fire extinguisher which is kept in my building, whether I will not get the deduction of it. Yes, you will get depreciation deduction from that, because it is of a special use. You cannot use it. You have to keep it. You have to keep it in your building, but you cannot use it until there is a fire in your business. So for that purposes, if it is a special use like a genset or a fire extinguisher, emergency space, then it all everything will be covered and the depreciation allowance can be taken. Okay, now if the assessee couldn't put to use of an asset because of a extraneous reasons, what is the extraneous reason? Like a paucity of the funds, yeah, or maybe the raw materials or the lack of labor. If you are not getting the raw material, if you are not getting the labor are on strike, the protest, or maybe any other reasons. If there is some reasons which is not in your control, not in your control, which is known as extraneous reasons. If anything, if your assets is put, if you the asset is ready to use, but you cannot put that machine to use because of some extraneous reasons, so then also the assessee will be able to take that depreciation benefit on that assets. I hope it is also much clear. Now, what are some explanations to section number 32? Section number 32 says that depreciation is mandatory. You have to 110% take the depreciation allowance. We will not let you to take, we will not let you to do not take the depreciation. You have to 110% take depreciation allowance mandatorily. Okay, it is mandatory for the assessee to claim the deduction. But here is a catch, like if there is a rate of 10%, if there is a rate of 10% and you have used that machinery, I am what I'm saying, used, put to use, I have used the asset for 180 days or more. If I have used that asset from 180 days or more, I'll get whole 10% deduction. But if I am getting 100, if I am getting less than 180 days, if I have used less than 180 days, then I will get only 5% deduction. That is the 50% of the original rate. The 50% of the original rate will be available if I will use for less than 180 days. I hope it is very much clear. The same it is written here. Now, coming on to the WTB. What is the WTB is? Now, as we said, the depreciation will be allowed on the WDB of the block of asset. So, what is the WDB? We are now going to see that. What is the WDB? WDB of the block of asset at the beginning. How will you calculate that? Just take WDV from the beginning, the opening WDV, that is the actual cost less the depreciation actually allowed, whatever the actual cost is, and whatever the year that you have used, you will reduce the depreciation for those years. You will get the opening WDV. Add the actual cost to the asset acquired during the previous year. Whatever the asset that you have acquired, you have to add that. It will be addition to your assets. Okay, second, money payable in respect of an asset of the same block which is sold, discarded, or demolished. Here the money payable means the sale price of the asset, including the insurance, salvage, compensation payable in respect of any asset. Okay, so what is the money payable? Money payable is the sale value. If you have anything say sold out, so just less than whatever the sale value is, including the insurance, salvage, compensation, everything, whatever you have received, just what do? Just reduce it. Okay. Now less notional depreciation. Notional WTV. So what is notional WTV? WTV computed as if the asset was only asset in the block. If like compute the notional WTV. What is the notional WTV? Compute the WTV as if there is no other asset. This is the only asset that you have in the block of asset that transferred by way of slump sale. So what it says, if you have any slump sale, it is like money payable is for the any single asset have you sold. If any single asset have you sold, then it will be reduced. But if there is any sale of a slum sale, if anything is sold as a slum sale is also the topic that we're going to cover in our series, the direct tax exemption exemption series. So for the notional depreciation, for that notional WDV shall also be reduced. It will not come in most of your question. Not this is not very much relevant. It will not come in your exam point of view as well. So, but if for remembering, just remember one thing: if there is something that you have slump sale, so the WDV will also be reduced from that notional WDV. I hope it is very much clear to you. Now, whatever the amount is received by us after reducing 2 points, adding 1 point to the opening WDV, whatever the WDV of the block of asset for the relevant assessment year, you will get. Now, on that WDV, you have to apply some prescribed percentages. Then you will get what? Depreciation. I hope it is very much important. Now, before going forward, we have to check what is the important ruling is. Ruling is CIT versus Kasturi and Sons Limited. What it says? It says simple one thing. It is held that money payable has to be interpreted only as the actual money payable in cash or by check. Actual money payable. Okay, not the benefits, not the kind. We will not take that, and not any other thing or benefit can be converted into money. We will not take any other thing. We will take only what on the actual cost, the actual payable. We have seen here the money payable. Here the money payable will only be interpreted as actual money payable in cash or check, not the other benefits or the things that you have provided that can be later on converted into money. That is not going to be there. Like someone issued the debentures to the company. I have no money, but for say that you have sold, you just sold me these assets. I am going to the I am going to give the debentures or the bonds of my company. That will be later converted into money, but it is not considered as a money payable. I hope it is very much clear to you all. Now, this is said the same thing like from the previous year 2021 or the assessment year 21-22, the depreciation on the goodwill is not going to be available. If there is something, if there is already goodwill coming on the WDB of the 1st April 2020, then you have to remove that goodwill from that WDB. This is the only point which they are saying. Okay, now the actual cost. What is the actual cost? Here we have also taken the actual cost of the asset acquired. So what is the actual cost? So actual cost means everything which you have incurred for acquiring that asset, everything that you have incurred for acquiring those assets are called as the actual cost. It means the actual cost of the asset to the assessee is reduced by that portion of the cost which has been directly or indirectly met by some other person. That whatever you have incurred, anything else, someone else has given you the subsidy, someone else has given you the grant, that will not be taken. Whatever you have actually spent for that asset will be part of your actual cost. Okay, now if you are spending something, so do not spend more than 10,000 rupees in a day to a single person by way other than account pay, check, draft, ECS, bank transfer, or through any other such or any other mode that has been prescribed by the government. Means a simple mean: do not spend in cash. Do not spend in cash. If you are spending in cash, aggregate payment, a single payment or the aggregate payment is exceeding 10,000 rupees in a day to a person other than these mode, means through cash, then such expenditure shall be ignored for the purpose of determination of actual cost. Then those that particular expenditure will not be amounted for the actual cost. It will be ignored. I hope it is clear. Now, the two provisions which are coming simultaneously. What it says, section number 43A, a special provision consequential to the rate changes in the rate of exchange. If there is some loss or the gain from the rate of exchange, there is a change in the rate of exchange. From that, you have what? You have gained something. So the conditions for applicability of this section, what it says, SSC has acquired an asset from a country outside India on credit or through a foreign currency loan. What it means, you have taken on credit or a foreign currency loan. Okay, credit or the foreign currency loan from outside for an asset. Okay, after the acquisition of such asset, at the time of making actual payment, if you have taken on credit, then when you are paying actually amount to the foreign supplier of such asset or the repayment of foreign currency loan, due to change in the rate of exchange, there is an increase or reduction of liability through the change in the rate of exchange. There is an increase or reduction of liability of the asset or expressed in the Indian currency, then such increment or the reduction in liability shall be added. If there is an increment, then it shall be added. There is a reduction, it shall be deducted from the actual cost of the asset. I hope it is very much clear. Nothing else to recall or to explain. Now, if there is any gain or loss due to change in the foreign exchange rates in respect of all foreign currency transaction, here what you have transacted for asset. Now if you have done any transaction in the foreign currency transaction, if you have done any foreign currency transaction, then it should be treated as a income or loss, which shall be computed in the manner provided in the ICDS. ICDS is same like a AS, like you have studied the AS in the CA intermediate, now IND-AS and CA final. So for the taxation there is also some AS, some standards by the government. What it says, income computation and disclosure standards, ICDS, computation and disclosure standards. Okay, but exception to this section is applicable in respect of which in respect of section covered by 43A. If this section is not applicable, if any case is covered under this point 43A, if any case is covered under 43A, then the 43AA section is not applicable. Now what we have said, we have said what we have said, see, we have said depreciation shall be allowed on the WDB of a block of asset at a prescribed percentage. We have understood WDB. We have understood what is the depreciation. Now we have to understand what block of asset and the prescribed percentages. If we will study this, we will know what this line is going to tell us. Now what is the block of asset? Coming on to the block of asset. Block of asset means a group of assets falling within the class of assets comprising tangible, intangible, except goodwill. Except goodwill, you know, on goodwill there is no depreciation, so we will not also include in the block of asset, because on the block of asset we have to give the depreciation at the prescribed percentages. And if in the block of asset we include the goodwill, then automatically the depreciation will also be charged on the goodwill. So remove the goodwill from the block of asset definition as well. Okay, at the same rate described in the depreciation schedule. What it says, same or similar type of assets are to be grouped in a similar block, in a similar container. That container will be a block at a prescribed rate. Suppose there is a prescribed rate for that block is 15%, then at the whole block there is a 15% flat depreciation allowance will be given, not to the particular single asset, but to a whole block of asset. If there is a furniture, then make all the furniture under a block. If there is a building, then make a building block. Okay, but if there is a building, but one type of building is temporary and another type of building is permanent, we have 10 permanent buildings and we have 5 temporary buildings. So temporary building block will be different and the permanent building block will be different. There will be two different blocks. Okay, on that basis only the depreciation is going to be done. Now, what are the prescribed percentages for the depreciation? The depreciation prescribed percentages are, for the building, if you are a residential building, the fifth of 5% is the depreciation rate. For residential, non-residential building, there is a 10% depreciation rate. And for the purely temporary erection, if there is any temporary building, then 40% is the depreciation rate. For plant and furniture and fitting, there is a 10%. Intangibles, 25%. But for plant and machinery, you have to remember one or two things. Okay, generally for the plant and machinery there is a 15% flat depreciation, but for the motor cars, for the motor cars there is a 15%. But if that motor car is acquired between 23rd August 19 to 15th August 19 and put to use on before 31st March 2020, if you have acquired between this and you have put to use before 31st March 2020, then the depreciation will be 30%. The 15% shall be added. Okay, the additional 15% will be given to you. But if the motor car or the motor car business, you are running them on hire, if you are in the business of running those motor cars or the motor buses or the lorries in your business, then the depreciation is generally 13%. But if you have, sorry, 30%. But if you have acquired from 23rd of August to 31st of March and put to use on or before 31st March 2020, then the depreciation at the rate of 45% shall be allowed. The depreciation shall be 45%. The additional 15%. Here also the 15% is additional. Now books 40%, computers 40%, airplanes 40%, air pollution equipment 40%, windmills 40%, molds and rubbers 30%, ships 20%, oil well 15%, and the mobile and EP bags 15%. These rates are need to be learned by you. I hope it is very much clear to you everyone. Is there any problem? You can comment me down in the description, in the comment box. Now, coming on to the additional depreciation. There is something called additional depreciation. What are the depreciation that you are getting? What we have understood is everything okay, but under the certain circumstances, we will also give you some additional depreciation. What are those circumstances? If you have acquired any new plant and machinery, if you have acquired or if you have acquired any new plant and machinery, and the assessee should be and the assessee should be engaged in the manufacturing businesses of any article or thing, or in the business of generation, transmission, or distribution of power. If you are in the power business or you are manufacturing anything, if you are in manufacturing businesses or in the power businesses, then and in relation to that, if you have acquired new plant and machinery, then the depreciation, additional depreciation will be 20% of the actual cost. What is the actual cost? That actual cost that we have just learned above. Okay, the depreciation is also allowed. The additional depreciation is 20%. This is a one time benefit. It is a one time benefit. Remember that it is a one time benefit. One time it will be allowed, other it will not be allowed. But if the plant and machinery again it is used less than 180 days, then only 10% is allowed for this year. The balance 10% will be carry forward to the next year. Is this point clear? This is the first point. Now, additional depreciation shall not be allowed. When the additional depreciation is not allowed, additional depreciation will not be allowed in the case of second hand plant and machinery, whether in India or outside India. Whether the second hand plant and machinery, if you have acquired from India or maybe outside India, that will not be available for the additional depreciation. We will not assume it for the new. Okay, now any machinery or plant installed in the office premise or any residential accommodation, if any plant or machinery is installed in the office premise or on the residential accommodation, there will not be any additional depreciation, and on any vehicle, road transport vehicle, there will be no additional depreciation is allowed. Okay, no additional depreciation on ships or aircraft, no additional depreciation on plant machinery, of which 100% cost is allowed as deduction. Like whatever you have acquired, and under the certain sections of this chapter, we will see 100% of the cost is allowed as deduction. If there is 100% of the cost is allowed as deduction, then such plant and machinery will not be entitled for additional depreciation. I hope it is very much clear. Now, if now what it says the depreciation. We have just studied the depreciation. The claiming of depreciation is mandatory. You have to mandatorily claim that depreciation. But by claiming, suppose my profit for the year is 100 cr. My profit for the year is 100 cr, and the depreciation, suppose my depreciation went to 150 cr. Now there is a loss of 50 cr, from which I am not able to adjust my depreciation. The 50 cr depreciation is can't be absorbed by my profit. Only 100 cr depreciation can be absorbed by my profit. So whatever the 50 cr unabsorbed depreciation, that the profit is not able to absorb that depreciation, that unabsorbed depreciation can be carried forward for any number of years. There is no time limit that 8 years, 4 years, 6 years, no time limit. Any number of years it can be carried forward. So the current year depreciation shall be the first set off against the PGBP, and the balance, if any, set off against the other head, if the balance is carried forward to the next assessment year. What is the set of criteria? You just take care of that. First, we will adjust the current year depreciation. Then we will adjust the business loss, brought forward business loss. Third, it will be brought forward business unabsorbed depreciation. This is the manner. In this sequence only you will adjust things. Why the first current year depreciation is adjusted? Because we have said that the claiming of current year depreciation is mandatory. So first we will claim this. If there is something excess in our profits, then we will adjust all those two things independently. Now what it says, unabsorbed depreciation can be carried forward for infinite number of years. You need not to worry about 8 years, 4 years, 6 years. It can be carried forward for n number of years. I hope it is very, very, very much clear. Now the depreciation in case of a power generating undertaking. So the power generating, we have understand something about, like a business of power or generation, they will get the additional depreciation. Okay, so what it says, they says, now for the power generation unit, for the power generating undertakings, there are two methods available. Whether they want to go with WDV, go, but they want to go with SLM, so you have also the method to opt SLM only for the power generating undertakings. Okay, SLM or WDV, whatever they want to take, they can take any one method of your choice. Now sir, if they have opted for the SLM method, then how will we calculate the depreciation? So the depreciation name under the SLM method is known as the terminal depreciation. What it says, if the selling price is less than WDV, if we have selling price less than WDV under the SLM, so the difference is what? Terminal depreciation. So what we call it? We will call it as a terminal depreciation, and it is allowed for the year of transfer. Then you can adjust that from your profit. I hope it is clear. Now, what it says, balancing charge and the capital gain. See, listen it very carefully. If all the assets are sold in the block, if you have a block of 10 assets and all the assets are sold, then your WDV becomes negative. Your WDV becomes negative. When it will becomes negative, suppose you sell for 100 CR and the WDV is only for 80 CR. So your WDV becomes negative and you get a profit of 20 CR, then the STCG will be 20 CR. If the WDV is left positive, suppose your selling price is 100 CR, but your WDV is 120 CR. Now 20 CR is your loss. Whatever you have the value, you sold it at a let price. So it will be a short-term capital loss. But if you have not sold all the assets, but some of the assets are sold from that block, like you have a block of a 10 assets, but you have sold only 5 assets or the 6 assets. So when the WDV becomes negative, it will be STCG. And if the WDV is left, now you have a block left, you have a WDV also left as positive. So now you will calculate the depreciation as usual. Okay, as usual, now you will calculate what? WDV. So for easy understanding, for both the provisions, terminal depreciation and balancing charge capital gain, I have given you a summary. Like if the selling price is less than WDV, then it will be called as a terminal depreciation. If the selling price is less than WDV, but sorry, is less than cost of acquisition but greater than WDV, then balancing charge under the PGBP, balancing charge will be taxable under the head PGBP. What will be the balancing charge? Sale price minus WDV. Okay, and if this is the situation, then there will be a STCG, and STCG will be calculated as sale price minus cost of acquisition, or there may be PGBP, which will be calculated as this way. I hope it is very much clear to you all. There is nothing much to explain. Now we are coming on to the important section number 33AB, a deduction in respect of the tree development account. What it says, it will be very much important to see. Now see what it says. Under the section number 33AB, what it says, if you are an assessee who is engaged in the growing or manufacturing of tea, coffee or rubber in India, then he should deposit any amount with NABARD under the scheme approved by the tea board or the rubber board, or in deposit account opened as per the scheme by the tea board or the coffee board or the rubber board with the previous approval of the central government. So what it says, if you are in the business of growing and manufacturing tea, coffee and rubber in India, then he shall deposit amount with the NABARD. Okay, with the approval of the central government. Okay, what is the time limit to deposit? Whatever the time limit is, 30th September of the relevant assessment year. You have to deposit the amount in NABARD by 30th September of the relevant assessment year. The accounts must be audited by the chartered accountant and audit report must be furnished 1 month prior to the due date of filing of return. I hope it is important. If you have, I think it is important. Okay, you know, understand it. Now, what it says, you have to deposit it with NABARD. So what is the quantum? Like I have deposited in the amount in the NABARD, then what is the deduction? What is the benefit that I am going to get? So it says least of the following: the amount deposited or 40% of the profit from business before 33 AB. We have to calculate 33 AB deduction. So before 33 AB, what is the actual what is the deduction we have to take? So before 33 AB, take the profit, take 40% of it or actual amount, compare these two, whichever is lower will be get as a deduction. Okay, now but you have withdrawal from that deposit. If any amount can be withdrawn, any amount can be withdrawn from NABARD or deposit account for the purposes, whatever the purposes is, we will see here specified in the scheme, tea board or coffee board, rubber board, or in the following circumstances. If you have applied, if you have withdrawn from that, but if you are withdrawing from the closure or the dissolution of firm, your the business is closing or maybe your the firm is dissolving, then it will be withdrawn. The any amount withdrawn will be taxable under the hand at the same time of receipt. Whenever you are going to receive that amount, it will be taxable in your hand. But in the case of partition of HUF, death or liquidation, it will not be taxable at the time of receipt. Okay, it will not be taxable. For what the purposes you must withdraw, the purposes when the NABARD or deposit scheme is utilized, the amount that you have withdrawn must be utilized as per the scheme or the purposes of any expenditure. Such expenditure shall not be allowed as deduction under the computation of PGBP. Okay, once we have already given you the deduction while depositing, we have already given you the deduction, so such expenditure on that amount will not be amounted to as PGBP income, shall not be allowed a deduction for the PGBP. Okay, prohibition for utilization. Now you have amount withdrawn. Now where you should not utilize those amount. So they say any machinery, plant and machinery installed in the office premise or the residential accommodation, any office appliances or any machinery or plant in which of which 100% cost is allowed a deduction in one previous year. You why like you can see all these points are from additional depreciation other points. Okay, all these points are very much very much same from that points only. Okay, it is 1 2 3. Okay, it is 1 2 then 3. All these points are same. You should not use it. It is prohibited for the utilization of the amount that you have withdrawn from the NABARD from these uses. You cannot use for these purposes. Okay, if there any misutilization of the fund, then it will be deemed to be the PGBP income of that previous year and it will be chargeable to tax in your hands. But if the amount withdrawn from the NABARD or depository scheme must be utilized in the same previous year in which the withdrawn, and in otherwise cases unutilized amount shall be deemed to be the profits or gains of the business or profession in the year in which it is withdrawn. So in the year where when like suppose for the previous year 23-24, in this previous year you have what withdrawn the amount, so in this particular year you must utilize that amount as well. If you have anything left, if you have anything left unutilized, then the unutilized portion will be taxable under the head PGBP. It will become the chargeable under the head PGBP. I hope it is also clear. Now withdrawal of exemption. If there is certain prohibitions, if there is certain violations, then we will withdraw your exemptions. What are the exemptions? Like amount withdrawn from NABARD, okay, utilized for assets as per the scheme, but such assets are transferred. You have withdrawn and utilized it for asset, that is allowed. Okay, till here there is no problem. But now you have transferred that asset within 8 years from the end of the year of acquisition. Now you have acquired in the previous year 23-24, because at the same year you have to utilize that, so you have acquired something in the previous year 23-24. Now you have transferred it within 8 years from the year of acquisition, means from the year in which you have utilized. If at that point you have transferred your asset within 8 years from the year of the acquisition, then the cost of such asset related to the withdrawal amount that you have claimed as deduction earlier under section 33AB, means under this section, shall be deemed to be the profits or gains of the business or profession in the year in which it is transferred. So whatever the year, suppose in the previous years 26 27, I have transferred that. So for that particular year, whatever the amount that I have taken as deduction under section 33AB will be amounted as PGBP income in the year 26 27. Then I have to pay tax on that particular income as well. Our deduction, what we have claimed under section 33AB, will be now withdrawn. I hope it is very much clear to you all. Now, for the activity of the tea, coffee, rubber, what it says, if there is a growing manufacturing, then 40% is PGBP income, 60% is agriculture. Here 25 to 75, 35 65. But if there is roasting and grounding also for the coffee only, not tea and not rubber, for coffee only, so there is more much. If you are roasting and grounding as well, so there is more PGP component, that you are more doing businesses. The agriculture must be same. So here the business income exceeds from 25 to 40%, and the agriculture income reduces by 15% to 60%. Okay. Now, how will you calculate this? First of all, allow deduction under section 33AB along with some other deductions as allowable under the head PGBP to obtain the net results of the business. So what it says, it simply says what? Just calculate your PGBP income and allow the deductions under section 33AB that you have taken just above. Okay. After that, apply the percentages. Now after that, you have to apply percentages 40 or 60. Like the profit comes, now it divided into 40 and 60%. 40% is PGBP and 60% is what? Agriculture income. This amount, it will be exempt if it is applied in India, then this amount is exempt, and on the 40% it will be taxable. It will be what? Taxable. I hope it is very much clear to you all. If the assessee has any brought forward loss, then that can be set off from the taxable proportion, that the 40%, any business brought forward loss can be set off, alright, by applying the rule percentages. Is this clear? 40%, by applying 40%, whatever the amount you get from there, you can also less the brought forward businesses losses. I hope it is very much clear to you all. Now coming on to the section number 33 ABA, deduction for petroleum natural gases business. It is important, nothing important. This is important, and there are certain items like this not important, given in your examination, given in your note, I say study material, that's why I have written here. But you can easily skip this page. You can easily skip this page till here. Okay, you can skip. Let me cut this. Also, this is no use. This is of no use. At this point of time, when you are revising for an examination, it is not at all important for your examination. You can deduct all these points. Okay, now coming on to the section number 35. What section number 35 says it is if there is any expenditure on the scientific research. If this says any expenditure on the scientific research, so remember one thing. If it is done, if that expenditure is done before, for the new business, suppose for the new business, if that expenditure, the scientific research expenditure, is incurred during the relevant previous year, whether in case of a new business or existing business, if there is a new business or maybe the any the existing business, the capital expenditure, the 100% deduction will be allowed on all the capital assets except the land. On the land, there will be no deduction will be allowed under section number 35. Okay, for all other capital expenditure, the deduction will be allowed, and for the revenue expenditure, all revenue expenditures are allowed. But if the business is newly commenced, and then the expenses incurred during the 3 years prior to the date of commencement of the businesses, what it says, if there is a new business, if there is a new business that you have to commence, but before commencing that business, you have done some scientific research for the 3 years, that my how my business will grow, how, what if I want to make something, I want to give some, suppose my system is IT, my business is IT oriented business. Okay, so I have to take what, I also have to make some softwares. I also have to make some patents, rights of the copyrights. So for that, I have already done what, research, or the scientific research part I have completed. So for that purposes, if that expenditure is done 3 years prior to the date of commencement of a business, then all expenditures are allowed except the land, and all for the revenue expenditure, only salary and material expenses will be allowed. Otherwise, all other expenditure will not be allowed. And due to deduction under section 35(1)(4), Business loss cannot be computed if profit is inadequate. Then same treatment as of depreciation. Suppose like 3514, like 100%, 100%, all the after taking all the deductions, suppose my profit is not that much sufficient to absorb all these kind of expenditures from the profit, so my expenditures are left to set off. So whatever the unabsorbed expenditure will be treated as similar like what unabsorbed depreciation, and it will also be carried forward for unlimited number of years, and you can easily carry forward that, and after that whenever you have profit you can just reduce it, but reducing it with the same sequence that we have already studied here. Like the first we will compute the brought forward carry forward depreciation, then brought forward business loss, second point, then unabsorbed depreciation. I hope it is very much clear to you all. Now, contribution to the contribution based deductions. Simply what I say, if you have contributed to any scientific research, social science or statistical research, contributed to national laboratory, IITs, university, persons approved by prescribed authorities, or the Indian company who is having the scientific research team, or which is approved by the CCIT, or in the amount is paid for the scientific research, means if you are paying anything to the scientific research or the social research, you will get 100% deduction. You will get 100% deduction. Now what it says, if the assessee shall not be denied, and assessee shall not be denied the deduction in respect of any sum paid to the institution to which section 31 to 2a 3 to 2a 2 3 2a 2a, okay, 2AA 2a applies merely on the ground that subsequent payment held by the assessee and the approval grant of such institution has been withdrawn. What it says, if you have given anything to the institution for the scientific research, the amount that you have given, you can take deduction whether or not that approval is granted. Where we said no, where we said you have to approve from the CCIT after giving your after giving your amount of donation, after giving the amount, the contribution that you have given, after that contribution made by you, the approval is withdrawn from the for that particular university or the institution. So on that basis, whether your deduction will be hampered, no, for you no deduction will be hampered. For you, you will take your deduction as usual. There will no be impact whether that such approval is withdrawn for that university or not. It is not at all mandatory, but your contribution is before withdrawal, not after withdrawal. Okay. Now, the deduction in respect of any sum paid to the research association, university, college, or other institution referred in section this shall not be allowed unless such research association, university, college, or institution or company. It's simple. It is simple. You have to give the deduction will be allowed to this only. Now, what it says, we will not give the deduction when we will not give any deduction when these two conditions are not fulfilled. What are these two conditions? Whether you have to remember that? No, just read it and forget. Prepare and deliver a statement. These institutions will have to prepare and deliver a statement in Form 10BD up to the 31st May of the next financial year about, as may be prescribed to the income tax authority, about how many donations, how many contributions that you have received from that company or from any from such persons, or you have to give us a list of those, like the SFTs transaction that you have in the that you have taken that you have might seen in your AIS statement. In your AIS, the SFT transactions are also shown. So these are taken out from these type of reports only. So from the 10 BD, you have to prepare a report and deliver to the principal DGIT. DGIT is Director General of Income Tax. Okay. Now second is furnishes to the donor a certificate specifying the amount of donation. Then you have to also furnish a donation certificate to the donor, so that they can also take deductions under section 35. They can also take deduction under section 35. I hope it is very much clear. This point is not at all relevant. Now coming on to the section number 35. We will complete section number 35 for today and 35 AD. Then we will do for tomorrow. Okay, these are the two sections that we have to complete now. 3580 says, if you are in the specified businesses, if you are in the specified businesses that we are going to tell, the 13 businesses, if you are in any of these businesses, then we will give you certain deduction. What are the certain deduction? We will give you 100% deduction of your capital expenditure as well in the year of its occurrence itself. Okay, what are those businesses? If you are setting up or operating any cold chain facilities for specified products, okay, now what is the specified products? Agriculture, forest produce, meat product, that you can study, that you can read. It is just a setting up and operating a cold chain facilities for a specified product. Second, what is the meaning of the cold chain facility? That you all know. Now, setting up and operating warehousing facility for storage of agriculture produce. Now, above what is? Above is the cold storage facilities. Now, here is what? Warehousing facilities. Both are different. Now, third, laying and operating cross country natural gas or petroleum oil pipeline networks. Then building and operating wherever anywhere in India a hotel of 2 star or above category as classified by the city. You have to make what? A hotel of 2 stars or more. Okay, now building and operating anywhere in India hospital with at least 100 beds, developing and building a housing project under the government scheme for the slum redevelopment or the rehabilitation of the affordable housing. If there is any housing project made under the slum redevelopment rehabilitation act, so it will also be covered here. Production of fertilizers in India, setting up and operating an inland container depot or the container freight stations, beekeeping or the production of many honey and bee bags, setting up and operating a warehousing facility for storage of sugar. Above we have said warehousing facilities for the agriculture produce. Now it is saying warehousing facility for the storage of sugar. Okay, both are covered here. Laying and operating a slurry pipeline for the transportation of iron ore. We have said is laying and operating of cross country natural gases. Here it says slurry pipelines, okay, of the iron core. Yeah, remember this. Setting up and operating a semiconductor wafer fabrication manufacturing unit as notified by the board, and the developing or maintaining and operating a new infrastructure facility like road, port, airport, etc. If you are developing any of these kind of things, if you are engaged in any of these businesses, then you will get what? Certain kind of deduction. What are those deduction? 100% of the capital expenditures as allowed as deduction in the year of occurrence itself. Okay, but if expenditure incurred prior to the commencement of business and the whole book, everything is already capitalized in the building in the cost of your asset, then will be allowed, then which is capitalized prior to, but that capital expenditure from which you want to take 100% deduction, that must be incurred prior to the commencement of this business, and it must be capitalized in your business, then only we will give you the deduction. I hope it is very much clear. Deduction under this section shall not be allowed in respect of what? For any expenditure incurred on acquisition of any land, goodwill, or financial institution. Here we will not give deduction for three things. What are those three things? Acquisition of land, acquisition of building, acquisition of financial instrument. If these are the things, we will not give you any kind of deduction for those things. Now, any expenditure in respect of which the payment or aggregate of payment in a day to a person in cash, other than by all these modes are in cash, only exceed 10,000. This is also seen in the actual cost of asset definition. Same thing is here. Now, what it says, condition for applicability, you have to either acquire a new business or a new plant and machinery. But see, here is the difference. And under the additional depreciation section, we have said it should be the new plant and machinery, not the second hand plant and machinery either from India or from outside India. But here we are changing our words. What we are saying, new plant and machinery subject to the exportation of imported plant and machinery or 20% of old block. What it says, it simply says, if you have imported anything plant and machinery, or 20% of the 20% of your plant and machinery is your old plant and machinery, then we will consider it that it is a new plant and machinery, and we will give you the deductions. Now, no deduction in respect of the expenditure allowed to the assessee under this section. Okay, Now, if the assessee claimed deduction under Section 3580 for any assessment year, then there will be no deduction under 80IA, 80 RRB, 10AA. What it says, if you are claiming any deduction under Section 3580, then forget about any profit link deductions, Section 10AA deductions. No deduction will go into. We will give you to anything. We will not give you any kind of deduction apart from 3580. You have already taken 100% deduction of your capital expenditure. Now, please do not come and ask for any other deduction from us, any profit link deduction to us. We are not going to give you any kind of deductions. Okay, in the same or any other assessment year, we will not give you any kind of deductions. Now, lock-in period. As in 33AB, what we said, do not sell that asset from within 8 years from the year of acquisition. Now what it says, lock-in period here also. After asset claim as deduction under this section should not be used, should be used only for the specified business. What are those specified businesses? The list of 13 businesses that we have just completed. It should be used only for that businesses only, up to the year of 8 years of the year of acquisition. It should be used for 8 years, at least for the years 8 years from the year of acquisition for that specified business only. After the 8 years, you can use it for a normal business, no issues. But for the 8 years, you have to use it for our business only. Okay, if there is any violation, so the same thing that you have already studied, the same thing will apply, like the deductions under section 3580 less notionally allowable deduction. Like if you have not received the 3580 deduction, then what will be the actual cost, and on that how what will be the actual amount of depreciation that you will get. Just reduce that actually depreciation, notionally actual depreciation will be reduced from the deductions, and on that income will be deemed to be the PGBP income in the year of the violation, and it will be treated as actual cost and will be added with the corresponding block of asset. If the asset is sold, destroyed in the aforesaid lock-in period of 8 years, we have said we have said na, you should only use for the specified business up to the 8 years, but my asset is destroyed, sold in that period of 8 years, then it then will not be treated as a case of violation. It will not be a case of violation, and there will be no consequences. Okay, but in such a case, total amount received as sale consideration of the insurance claim as may be will be taxable under the head PGP under section 28. We have already seen if there is any sale consideration of the insurance claim will be taxable under section 28. I hope it is clear. Now coming on to the last part of this session, first part, that is amortization of a preliminary expenses. For the preliminary expenses before starting the business, you have done any kind of expenditures. You have done what? Any kind of expenditures. Then you will get you will give we will give you the preliminary expenses deductions. How we will give you? One fifth, one fifth, one fifth, one fifth, one fifth. For 5 years, you can take that benefits. Okay. Who are the eligible assessee? Any resident person should incur expenditure on specified purposes. What are those specified businesses purposes? Covers expenses on project report, feasibility report, engineering services, market survey, company registration expenses, expenses on issue of shares, debenture, memorandum, article, any kind of business, any kind of expenditure for starting of your business. If you have done either before commencement of businesses or after commencement for extension or for starting up a new unit, if anything is done, then how the amount will be calculated for that. Qualifying limit, what is the qualifying limit is, in case of a company, 5% of 5% of capital employed or 5% of cost of project, whichever is higher, will be the amount. For that basis, it will be allowed in the 5 years. But for any other businesses, 5% of the cost of project, not the capital employed, only the cost of project will be taken, and yearly quantum will be actual expenses or qualifying limit, whichever is lower will be allowed to you as deduction. Now what is capital employed? What is cost of project? So it says capital employed is share capital, issued share capital. It says issued share capital plus debenture plus long term borrowings. Share premium will not be part of the capital employed. And what is the cost of project? Cost of project is the actual cost of the fixed asset. I hope it is very much clear to you. Now, as exist on the last day of the first year, on the last day of the first year of deduction, which is as follows. In case of a business, new business, year of commencement of business will be taken as the last year. Okay. In case of extension, year of completion of extension. In case of new unit, year of start of operation of the new unit will be taken as exist on the last day of the first year of deduction. Is this clear? I hope it is clear. from the till when it is allowed, till for the 5 years the amount qualifying limit amount will be allowed, like actual or qualifying limit, whichever is allowed, for one by fifth for 5 years. I hope it is clear. From the year of commencement of businesses, if it is before starting, if it is after commencement of business for the extension, then it will be allowed from the year of completion of extension. And if it is for the new business unit, then it will be start from the year of operation of the new unit. I hope it is clear. For the amalgamation or the demerger, outstanding installment will be allowed to the transferee company. Suppose I have taken the deduction under the preliminary expenses, I have to take deduction, but my business is amalgamated to some other company, and two installment is left to take the deduction for. I have taken the deduction for 3 years, just 2 years are left. So the amalgamated company can take the deduction of that outstanding two installments. Is this point clear? In case of a non-cooperative assessee, the assessee is required to furnish the audit report 1 month prior to the due date of filing of return in the first year. I hope it is clear. Now, section number 35 DD or 35 DDA, what it says, similar things, similar lines, same thing. Eligible assessee, Indian company or any other persons. What are the eligible expenditures? Expenses for amalgamation or demerger. Firstly, we have said expenditure on preliminary expenses. Now we are saying any expenditure done on the amalgamation or demerger, or maybe the VRS of this employees. So the what is the quantum? 20% of the such expenditure will be allowed as deduction. But in how many number of years? In 5 years. Now, from where the 5 years will start? From the in the case of amalgamation demerger, year of amalgamation or demerger, or for the case of the VRS, year of occurrence of such expenditures will be allowed. In case of amalgamation, demerger, succession, or conversion, before 5 years, if anything has happened before 5 years, amalgamation, demerger, succession, or conversion, if anything appears before 5 years, then what? Under this case, nothing is given. But for the VRS, what it says, any outstanding installment will be allowed to the transferee. I hope it is very much clear. Now, section number 36, 37, these are the most two important. Otherwise, all these things are very easy. We will complete it in the next class itself. Okay, I hope you have understood it very well. Now, I do not find it very important from starting 44AB audit of accounts, that you have already studied, and it is very easy. Like the 44EE presumptive taxation, 44AD, and the 44ADA. These are the four sections. I do not find it very important. Teach me. Everything is known to you, and you can easily complete that as well. So I will complete till here till tomorrow. Okay, tomorrow this chapter will also be completed by from our side. It is not as big as it is looking like. It is very easy chapter. I hope it is very much clear to you. If you like our session, so please comment down in the comment section. I will see and I will reply as soon as possible. Thank you so much for watching, and let's meet tomorrow and complete this chapter. Take care.